Welcome everyone. Today on the Joseph Carlson Show, I am buying $10,000 to $20,000 of this stock. The company's Mastercard. Now, everyone knows about Mastercard, but for most of you, your impression of it would be that it is a credit card company. That's about it. It's just one of the big credit card companies. Nothing really exciting going on about this one, but you'd be wrong. Many investors don't realize what's actually going on behind the scenes with Mastercard. Mastercard has evolved far from a credit card company. In fact, that is an outdated view of this business. Mastercard could more accurately be described now as a global commerce operating system, a business that is a cybersecurity firm, one that has unparalleled level of data. It's a company that the more that I researched it, in fact, I did a lot of research over the past couple of days, the more that I realized that this is one of the most misunderstood stocks in the market. People's perceptions of Mastercard and what it actually is are dramatically different. So we're going to dive into it today. We're going to be looking at the stock as well. We're going to be looking at the price point of it, why it's traded flat this year, despite the fact that it's had incredibly fast growth. Mastercard is growing very fast. The economics are incredible. The moat is insanely wide. But what's lesser understood, again, is the pivot that's happening with the business model. Mastercard is changing its business over time. It's changing its core value proposition. And even the revenue that it's gaining is changing. We're going to be going over it, and I want to dive into this one because it's already a large position in my portfolio. It's a company that I don't talk about too often because, frankly, it's considered a boring company. But when I looked at this one, I became more and more excited about it. It's something where I realize that this is, again, one that people just don't understand. So we'll be diving in it, learning about the new businesses that Mastercard's going into, and the reason that I'm buying another $10,000 to $20,000 of the stock. Now, as always, we have a lot of other news to get to. For example, Google finally peaked above $300 per share. There's a lot of gain taking as that happens when a stock goes up to all new highs. It was up 5.5%, and then it's traded down to just up 3.5%. Google continues to lead the Max 7. It leads the market. It's just crushing everything right now. What is going on with Google? Well, of course, they released their new Gemini 3.0 model, and it's good. It's really good. We're going to be going over it. I'll be sharing some thoughts of what this model does, why investors are so excited about it, and how Google fits in with the rest of my portfolio. We'll be going over the positioning of Google. Now, of course, we have on the calendar today that Nvidia is posting their earnings. We'll be going over what are the main factors investors are looking for. And then finally, as I was looking for my new Fail of the Week segment, I found this clip, which was reportedly supposed to be a fail of the week, but as I watched it, I had the opposite reaction. I'll be going over what I think is the win of the week. We'll be looking at why I think this TikTok video is actually genuinely good advice. So we have a ton to get to in this episode. As always, if you like this type of content, you can check out more content. We have exclusive episodes included in the Qualtrim membership. That's right. When you join Qualtrim, you not only get this platform, this stock analysis tool that has stock insights, DCF calculators, it has earnings calendars, portfolio AI overviews, fundamentals that go back 30 plus years, all for a very low price. You get exclusive episodes of the Joseph Carlson Show. I'm releasing them every single week. So check it out. Sign up now at qualtrim.com. Now I'm going to go into the new buy. We're going to be talking a lot about Mastercard. But before we do that, I just want to take a quick pit stop on the way and check in with Google. It's another time that we can just celebrate. And I know we've had a lot of celebrations about Google, but that's only because this stock just goes up. That's what it's been doing. And this is one that I'm very happy about because I've said for a long time, Google will go above $300 per share. Early this morning, it did just that. It peaked above $300 per share. Lots of investors celebrated. Some of them took gains. It's down to $294 per share. It's going to go back up. This will be above $300 per share. In terms of the positioning, there's time periods where I've been more bullish on Google than others, time periods where I've been a little bit concerned about Google. But overall, what I believe I did the most right with this position is when I finally came to the conclusion that Google is fine, when I made that conclusion far before Wall Street did, about 6 months before Wall Street did, I bet heavily on the stock. When I came to that realization that Google is going to be all right, I put more money in the stock than I usually do. I followed Charlie Munger's advice that when you have an edge on a stock, when you believe the odds are heavily in your favor, that's when you should bet big. If you don't bet big during those time periods, well, you're just going to miss out. And you don't have that many time periods where you know something the market does in advance. So in this case, this was one of the rare cases, the opportunities that come once in a while, where investors can figure something out long before Wall Street does, months and months ahead of time. If you do figure that out and you're highly confident in your decision, you believe that the downside is extremely limited and the upside is very material, that's a time period to bet big, to put more money into a holding than you usually do. Looking at it combined today, Google is a $175,000 position, $77,000 in the green. That doesn't count dividends. With dividends, it would be about $82,000 in the green. Google has passed up even my gains in Netflix. Now, why is Google stock continuing to go up so much? Well, of course, it's because the Gemini 3.0 model was released. Like Sundar Pichai said, he's mentioned it many times. It wasn't a surprise. He said he's going to release it by the end of 2025. He said it's really good. Well, it is. And this is the reaction to it.
Hey, Morgan, that's right. It was the Gemini 3.0 launch, and Alphabet shares are higher today. So a bright spot amid sort of this larger anxiety rattling the AI trade. It's been volatile, though, because the market's not just tracking model quality or traffic anymore. It's tracking CapEx, the rising role of debt, circular financing. Plus, the Gemini 3.0 launch, excuse me, it has to compete with comments from Sundar Pichai to the BBC today, where he says that the trillion-dollar AI boom has elements of irrationality, and he says no firm is immune if the bubble bursts.
Now, that's a quote that's taken out of context. It's true that Sundar Pichai said that there's elements of irrationality to this market, like there always is. But he mentions, I think 3 times, maybe at least twice, that the momentum right now, the excitement around AI is rational. That's what Sundar Pichai says. He says it's entirely rational. People should be excited about AI.
Alphabet has, however, and this is what Morgan alluded to, outperformed the other big AI players over the past 3 months. It's at least climbed, if not obliterated, the wall of worry. Investors are finally appreciating this deep integration that Google has, from its chips, its TPUs, to models, cloud ecosystem, which also underpins this Gemini launch. Now, this is another benchmark-topping model, and it shifts.
Google has obliterated the wall of worry. Now everybody's looking at it, and it's like the greatest AI company. It has all this stuff working out, the whole full stack.
Gemini at the scale of Google. That's how Sundar Pichai put it, meaning that it'll be integrated into AI mode, and that's the default experience for most Google users, not just the ones that are seeking out AI chatbots. Meanwhile, the Gemini app, for those that are seeking a chatbot, it does continue to close that gap between itself and OpenAI's ChatGPT. Pichai says the app now has 650 million monthly active users. OpenAI said in August that ChatGPT hit 700 million weekly users. And then you've got third-party data from SimilarWeb backing up that trend, if it's not exactly apples to apples. So
Google continues to win. They're winning across the board. So as of now, I continue to hold all my shares. I'm glad to have it as my top position. I'm reluctant to do what a lot of super investors are doing, trimming their Google. I think that's a mistake. I think it's a bit too early. I do believe that the valuation to quality gap is closing for Google, but I think it will be mostly closed at around 350. I think there's still a ways to go. Now, moving on, we get into another company that I don't talk about quite as often. We have the Story Fund here. This company isn't in the Story Fund. If we switch over to the passive income portfolio, we can see where this holding lives. It is Mastercard. Mastercard is in the finance category. Now, the position size is $100,000 and it's $29,000 in the green. And like I've mentioned before, Mastercard historically, at least the way that I believe most investors view the company, is a credit card company. And if you don't view it as a credit card company, you probably just view it as a payment transaction company, a data company, one that facilitates payments across the globe, competing with Visa. And that's a correct view for about half the company, for about 50% of it. And in fact, a declining portion of the company. Over time, that's going to be a minority part of Mastercard. What you're missing with Mastercard, and what I believe most investors are missing, is this other massive, incredible business that's growing much faster that they've built while doing so very quietly. In fact, Mastercard doesn't really talk that much about this business. They just grow it behind the scenes year after year after year. But Mastercard has been making an aggressive pivot from their main value proposition of being just a credit card company to being a high-end data and security company. When we look at Mastercard here on Qualtrim, we can see the overall revenue. This is just the quarterly statements over time, every quarterly revenue, and it's growing rather fast. You can see the growth is 16.7% revenue growth over the past year over year. Now, if we compare that to Visa, Visa is not growing quite as fast. If you look at Visa's revenue, you can see that it's grown at 12%. So Visa's at 12%, MasterCard's at 16%. Why is Mastercard growing so fast? If we look at just the payment metric, this is actually growing around the same speed as Visa. So they're both growing around the same. The payment network of Mastercard and the payment network of Visa growing around the same speed. But where is that 17% growth coming from? And that's this other segment here called value-added services. Value-added services grew at 24.93% year over year. So basically 25%. When you average it out, that's the reason that Mastercard is growing so fast. So what is this value-added services? That seems very vague. We don't really know what that means, and that's where we dive into a little bit of research. The value-added services is extremely meaningful. In fact, calling Mastercard a credit card company is becoming outdated. They are rapidly morphing into a data and security firm that happens to process payments. In 2025, these value-added services, VAS, are no longer just a side hustle. They're the company's main growth engine. The hard numbers, it is massive. That segment represents 37 to 38% of Mastercard's total revenue. It generates approximately $11 billion annually. To put that in perspective, Mastercard's service business alone is larger than the entire revenue of many S&P 500 companies. The growth rate, this segment is consistently growing at 20 to 25%, significantly faster than the core transaction business, which grows roughly 10 to 12%. This service business for Mastercard that nobody ever talks about is growing as fast as like cloud companies. It's growing faster than Microsoft. It's growing faster than Google. It's growing faster than Amazon. It's growing as fast as Meta, but it has higher margins. Yet this line of business, again, is just never mentioned on the news or anywhere else. And I find that very interesting. So what exactly is this stuff? Mastercard effectively sells peace of mind and intelligence to the same banks and merchants that use its payment rails. The three main pillars of these services are, first, cybersecurity and fraud, the biggest driver. This is the lock-in mechanism. They use AI to monitor billions of transactions in real time to stop fraud before it happens. They also sell identity verification, verifying who you are and what you say you are, and device intelligence. They have acquired key acquisitions like the Recorded Future, a threat intelligence company, for $2.65 billion that allows them to sell detailed cybersecurity and intel to government and banks. And they have a lot of business with a lot of governments, moving completely outside of the payments category. Why it sells? If you are a bank, you could build your own fraud detection, or you could just pay Mastercard to use the data from 3 billion cards that they already monitor. It's an easy sell. So the reason that they don't have some massive marketing budget is that they have a product so incredibly distinguishingly good that it literally sells itself. They just have to go out and contact banks, tell them what they offer, they will sign up for it. Then you have part two, the data and analytics and consulting. Mastercard sits on one of the world's most valuable data sets, real-time global spending habits. What they do, they strip the personal info and sell the trends to retailers, governments, and banks. And this is where we get into one of the most incredible examples of this product that Mastercard has. You can take the example of a retail chain like Starbucks or Target. They might hire Mastercard to answer the question, where could we open our next 10 stores based on where high-spending coffee drinkers actually live and walk? If these companies are actually trying to determine where they're going to get the best ROI from their locations, they ask Mastercard that. Mastercard can definitively answer that question in a way that no one else can. They have a massive internal consulting arm, Mastercard Advisors, that functions like McKinsey for payments, helping banks optimize their portfolios, helping retailers and different restaurants know where to open. Any of these type of large companies are going to be going to Mastercard to answer these hard questions. Then they have loyalty and rewards. Mastercard manages the back end for airline miles, hotel points, and credit card cashback programs. The hook is that when Mastercard runs the bank's entire reward portal, that cannot be easily switched to Visa without disrupting their customers' points. This creates incredibly high switching costs. These are very unique and compelling products from a very fast-growing business, 20 to 25% revenue growth again in the top-tier premium category. And you may be saying, well, what is so unique about it? After all, there's Visa. Don't they offer services as well? They do, but they're actually more different than you might think. They do compete on value-added services, but with different philosophies. Mastercard has leaned heavily into technology and especially cybersecurity. Visa has leaned far more into payments, direct payments. Mastercard is aggressively trying to be a technology and consulting firm first and a card network second. They are pitching banks on service-led relationships. They want to run a bank's loyalty program, manage its cybersecurity defense, and consult on where to open up new branches. So they're saying that they're going to be like this entire consulting firm. They're going to kind of take over the operations of the bank, and they'll also just throw in their card network as a bonus. That is very different than what Visa's doing. The pitch: hire us to run your entire back-end tech stack, fraud, loyalty, data, and oh, by the way, issue our cards. Visa's strategy is very different. They are the network scale strategy. Visa competes by emphasizing its massive scale and reliability. Its value-added service offerings are often to tighter the transaction itself, like dispute resolution, risk scoring, and payment processing optimization. The pitch with Visa is we have the biggest, most reliable, and most accepted network. Our services ensure that your payments never fail and your fraud is low. Stick with the leader. Both of these companies are leaning into different categories. Now, Visa and Mastercard compete aggressively. You'll notice that some banks have exclusive relationships with Visa, like JP Morgan. And then you have some banks that won't have exclusive relationships with either. They'll issue some of either cards. In those cases, they just want the benefits of both. But both of them are growing because global digital payments are growing, and there's major tailwinds for both of these companies. After all, there's still trillions of dollars in cash that'll eventually be moved to digital payments. And Mastercard is positioning itself, I think, in a very advantageous way, where they're going to grow naturally and organically throughout the world, throughout Europe, throughout emerging markets, into places where there's going to be more digital payments. But they're also positioning themselves in many ways to be like a Palantir of banks. I know it's a crazy comparison, but the more you think about it, the more it makes sense. They are becoming this overall digital platform that has an immense amount of data, that uses that data to look for things like fraud, to verify its customers, and to make consulting decisions for expansion. This is a company that's leveraging its immense data to grow a business 20+%, even at their already massive scale. So we have Visa and Mastercard competing with the banks, trying to get as big of scale as possible. They're also competing for fintechs and smaller companies that will eventually grow to large institutions. And they're competing for scale in their payment processing. But remember, Mastercard is not going for just scale. They believe there's a bigger opportunity and a bigger growth path by this consulting arm becoming the operating system for global commerce. And they've already built out an incredible business doing so. I believe from here on, it's just going to be executing. And this isn't something where they're only targeting banks. In fact, a lot of their customers aren't banks. Their first big customer with this SaaS company is governments. Mastercard is effectively a government contractor for digitalization and cybersecurity. Mastercard now sells threat intelligence directly to 45 national governments, including the US and allies. You have disbursements. They build the backend for the government to send welfare, pension, or emergency relief payments directly to citizens, bypassing checks. So they're not only selling cybersecurity and threat intelligence to governments, they're also just building the backbone of financial payments in the government. Then you have tourism analysis. Governments hire Mastercard to analyze spending patterns and tourists to better target advertising and infrastructure and planning. So you can see how that can be useful. If the government wants to spend $1 billion to, build up a national park or advertise some part of their country, they want to know what tourist habits look like. These are important decisions. Retailers rely on Mastercard for consulting because literally the only other people that can do what they do is Visa. They're the only ones with the data. They have this massive duopoly that they can leverage. They have test and learn software that tells retailers exactly what will happen if they change a price, open a store, or run a promotion. And this is how this works. Unlike general consulting firms that use models or surveys, Mastercard uses anonymized transaction data. It doesn't guess if a Starbucks promotion cannibalizes sales at a nearby Dunkin'. It sees the card swiping at both locations in real time and allows for a closed-loop attribution that Google and Meta can only dream of. Now, this is a data advantage so good that Google and Meta could only dream of having it. Now, that seems a little crazy. After all, isn't Google and Meta like the data companies? Don't they know everything about everything? Well, not really. Mastercard actually knows more. They know more about where people spend money because they actually know exactly when you swipe a transaction, the exact place you were, the exact merchant, the exact amount you spent, and when you did it. Exactly for almost everyone. The sample size in this case is so massive, it's like half of society, that they can track it with extreme levels of accuracy. And what it's saying here is that basically, A normal consulting firm can say that you can lower prices on a product and you can see sales go up, or you can raise prices on a product and maybe see sales stay the same. But what happens to the restaurant next to you? What happens with their sales? The consulting firm isn't able to see that. With the closed loop of Mastercard, they can see not only how your business is having its sales affected, but how a nearby competitor is having its sales affected at the exact same time. They can look and say, hey, your sales are going up, theirs are going down, or theirs are going up. And they know 100% because everybody using their cards at that location is feeding them that data. That is a wide moat advantage, one that can't be replicated unless you build a network as big as Mastercard. The only other company in the world is Visa, which Mastercard has capitalized on this intelligence business and on this consulting arm. And again, this is just one example of how incredible these advantages are and why this large business is growing 20 to 25% per year. We look at other things, and there's so many features and things that are unique to Mastercard that we could highlight. Dynamic yield, personalization. They have network levers like the recorded future and network data. They're combining their data with cybersecurity, identity verification. They have the pre-transaction identification, which is a massive moat. And Mastercard productizes all of these different products. They sell them as standalone products to any company, just like a SaaS company. Once these companies build these products into their flow, they're deeply embedded. So this revenue growth isn't only fast, but it's also very reliable and very predictable. Now, looking at that and looking at the mode of Mastercard, the developments of this company, going from a payment network company to a cybersecurity consulting arm, this is a company that has so many ways to grow, so much power behind what it's doing, and it's trading today at a 28 forward PE. To me, that's not an expensive price, especially for one that has 45% profit margins with operating leverage. It's also trading at a 3.6% free cash flow yield. In fact, Mastercard has gone nowhere this year. It's literally flat year to date. It's traded down over the past month. Why? For no particular reason, just because it's not AI. Mastercard isn't an AI company. Nobody wants to own this old stodgy company. It may be leading in all these different categories and growing incredibly fast and has high margins, but for whatever reason, it's getting left behind. The market doesn't care about it. Well, I haven't forgot about it, and I like the company. I like the business. I like the direction. I like the way that they're pivoting. I like the consulting arm. I like all the services they're building. I like that it's super wide moat and it's developed a side SaaS business. It's growing above 20%. I like everything about it. And I even like the valuation. When we look at the discounted cash flow calculator, we can look at the valuation of the company and make some simple assumptions. Basically, any assumption that I make. If Mastercard trades at a 35 PE ratio and grows only at 15%, then you get a 15.8% return over the next 5 years. The stock price would double. This would be a market-beating position. But Mastercard's more likely to grow at 20% earnings per share, so you're going to get a 21% growth rate. 21% CAGR, Mastercard will be $1,360 by the first quarter of 2030. We can switch over to the cash flow and do it based on its free cash flow per share. We look at this, and again, I assume a simple 20% free cash flow per share growth over the next 5 years. It's growing at rates 25% and above. If we assume that it goes to a 3% yield, which is appropriate for this company, we get a 25% return over the next 5 years. The stock price would be $1,570 by Q1 of 2030. Right now, it's at $526. I am buying Mastercard. I'm going to buy another $10,000 of it. In fact, I have money being transferred into the brokerage today. I'll probably execute the buy tomorrow. And then I'm going to be transferring another $10,000 in, buying another $10,000 of this company. And I don't mind building this position bigger and bigger because right now, I believe it's one of the best risk-adjusted companies in the market. Now let's go to move on to some news here. The biggest news, of course, is the Nvidia earnings. Let's go ahead and share some thoughts about it. We have Nvidia reporting earnings, and it's one of those situations where I hear this every single quarter. And frankly, I'm a little bit tired of hearing it. That Nvidia is the whole market, and the whole market's dependent on Nvidia. But that is kind of the situation. The market does rely on Nvidia because all the big tech companies that have been leading the market are intertwined with Nvidia to some degree. But I think that this is becoming lesser of a story over time. There's people like this chief investment officer, Scott Martin, saying, quote, "This is a so goes Nvidia, so goes the market kind of report." Analysts expect the chip behemoth to show more than 50% growth in both the net income and revenue in its fiscal third quarter. The reason is fairly straightforward. Microsoft, Amazon, Google, and Meta, which taken together represent more than 40% of Nvidia's sales, are projected to increase their combined AI spending by 34% over the next 12 months to $440 billion, according to data compiled by Bloomberg. So these four customers represent over 40% of Nvidia's sales. Now, there's lots of quotes here of analysts saying that they're concerned that these companies are continually raising investors' expectations, they're raising the bar, they have to feed the market with rising expectations, and it is a dangerous game for public companies to play. So it's like the ante's always getting upped and upped. It's like you're doubling down on your bets in Vegas, and eventually it's not going to pan out. Now, I actually disagree with this. I think that Nvidia is not just trying to up the ante, but they're fulfilling on demand. And right now, there's such an insatiable demand for artificial intelligence, for all this processing and the efficiency that can happen from it, that it's a real product with real demand. This isn't something that's hyped up that they're trying to just build momentum. They're trying to describe how excited they are about a real phenomenon going on. And I believe that this quarter, Nvidia is going to be fine. The reason that I choose not to invest in it is because I have some persistent concerns about this company. One of them is that Nvidia is a company where its own customers, like it noted here, 40% of its revenue comes from only 4 different companies. Those companies are trying to mitigate Nvidia's impact. They're trying to essentially replace Nvidia. Google's doing it with its TPUs. We have Amazon doing it with its Trainium. All of them internally are trying to develop their own chipset to train and do different things that Nvidia previously has done. But I don't love the dynamic where your own customers are actively trying to replace you. It's a bit like if we looked at ASML, and every single customer of ASML was actively working on building their own lithography machine. They were developing it, they were putting huge infrastructure into it, and they're eventually going to build their own lithography machine. Well, it's a bit like what these customers are doing with Nvidia. Google's TPUs are highly effective. They've already shown with their Gemini 3 that they can train the best models with their TPUs. This is also a big selling point. So I see this as just one long-term concern about Nvidia. I believe the cloud companies themselves are better risk-adjusted bets. Now moving on, we get to what I originally intended to be the fail of the week, but after reviewing it, I decided it would be the win of the week. Let's go ahead and take a listen here. This is someone from TikTok, don't know who it is, but she uploaded this take and went viral as now a lot of people seem like they're figuring out investing. Let's go ahead and just take a look.
Guys, I'm literally shaking right now, and I gotta share this with somebody because I don't think that people know that the average person right now can make a lot of money. We're talking about millions, okay? No, I don't have a course to sell. No, this is not a sponsored video. Do you remember how back in the day, people made their wealth because they bought a lot of properties when properties were like $5, right? Those days are unattainable now. But our equivalent...
Okay, so there are some exaggerations here. You can make millions, right? That's always a bit of an exaggeration. Anytime somebody starts off their pitch with "you can make millions," that usually is a bit of an exaggeration. Obviously, saying that homes back in the day were $5, bit of an exaggeration, but you get the point. She's trying to make a point here. Let's go ahead and just take a listen.
Equivalent to that is literally investing in the stock market with what's going on with AI and tech, okay? Because we literally, if you're an adult right now, you have a front seat to what's going on and seeing how our world is literally changing right before our very eyes. You know how before people would say, damn, if I invested $1,000 into Starbucks in the 90s, I'd be a millionaire. If I invested $1,000 into Amazon in the 90s, I'd be a millionaire. This is our opportunity for that. What is happening right now is literally something that's like, for a lot of people, it's going to be once in a lifetime. This is going to be a time that people will be jealous of in the future because they'll be like, I was 8 years old when that was happening. I didn't know that. I couldn't do that, right?
She's right. I think she's right. I agree with everything. You look at some of these companies, and it's true that if you invested in Starbucks early on, Walmart early on, Home Depot early on, you would have become a millionaire if you just held those shares. In fact, I know someone, a relative, that bought $2,000 worth of Apple stock in 2002, soon after they launched the Apple iPod, I believe it was. At that time, he thought it was a great company. He held that $2,000 from then until now, and it's well over $1 million. So there are investments you can make early on. If you identify the right companies, a little bit of luck, and you hold long term, you can make a lot of money. So this video was originally something where a lot of people are reacting saying, oh, it's time to sell. Normal people are finding out about the stock market. I'm all for it. I think they should. I think investing is exciting, and I like everything about this message. That's why it is the win of the week. That's going to be it for this episode. See you in the next one.